JK is asking, you've been saying strong dollar for quite some time now, and you're positive on some emerging markets. Aren't these positions working against each other?
No, from a long-term tail perspective, no. I mean, we've been bullish on the dollar going back to 2013. So no, I mean, from a long-term perspective, the dollar, when it corrects, is range bound, and it really hasn't done what the bears have hoped. So that's a long-term call. If you look at real-time alerts in the dollar, I'll sell it, I'll buy it. It's just immediate terms, very different than the long-term, obviously. That's why we operate across multiple durations. So again, trades 3 weeks or less, trends 3 months or more, tails 3 years or less. So from a long-term tail perspective, we think that the currency war will be won or continue to be won by the dollar. In emerging markets, if you go back to when we started making that call, and I don't know how long ago it was, on 3 years ago in EM, 4 years ago?
3.5.
We're still plenty happy with that call. And since we've actually turned bullish on some emerging markets, now that we've seen the emerging market correlation not be the same across every single emerging market equity market, which at one point it almost went to 1. Yeah. So again, dollar up and it all went down. Now we like Taiwan, we like Malaysia, we like Brazil, we like South Korea. South Korea I put fourth on that list because that's how I rattled it off. So that's how we've thought about it. We evolve our process. Unlike many people, we change our minds, and as the data changes, we will.
Absolutely. And I'll make the broader point that I made in the note when we sort of stopped being bearish broadly on emerging markets about a month ago. The point is, I don't have a strong opinion on the directional beta of the asset class. So what we want to be doing in that scenario is pairing off longs versus shorts in terms of picking countries and picking asset classes within EM. So we obviously like the countries that you just listed, but we don't like Mexico, we don't like Indonesia, we don't like Thailand. So in terms of not having to take directional risk in the emerging market space, you compare those things off long and short.
Yeah, we'd say so in the alpha generation space. We don't want to we don't market an asset class. I don't run an EM marketing department. So. Nor do I run a commodities marketing department. That's why I probably don't get as many meetings in Chicago as I get, in different places where we've told people to short MLPs and commodity-oriented securities. Mm-hmm. We don't do that. So it's a lot better to not just say I like EM or I don't like EM, and I'm just going to pull out the components of EM that I like and throw away the ones that I don't like. That's how you beat everyone who plays EM, because they can only kind of shop in that one EM store. So again, EM is something that we probably have the most amount of work to do because it has the most ground to cover. And again, there's a lot of exciting things going on there that I think that this most recent spat of underperformance by EM-only bulls for the last 3 to 5 years, there's going to be things to be bullish on, things to be bearish on in EM.